High net worth families can go broke too. And with many years of experience in the industry, I've seen it happen time and time again. Whether you come from money or you're simply trying to protect your investments, these are the 5 biggest mistakes I see families make and how you can avoid them to secure lasting financial stability for yourself and your loved ones. And I have to say, the 5th mistake is the most common. And I discuss it almost every single time I meet with a new family. So let's jump in. Here's something most people don't realize. The same strategies that build wealth can actually destroy it if you're not careful. You can nail every investment, every market cycle. You can pick the top and the bottom, buy, sell, and you can still lose everything. It only takes one lawsuit, a divorce or a tax mistake, and everything that you've worked for is gone. But it's completely preventable. Wealthy families that last generations aren't just good at making money, they're obsessed with protecting it. They understand that once you have a significant amount of assets, you're playing an entirely different game with entirely different rules. And today I'm breaking down the 5 most critical mistakes that separate the families who build wealth that lasts and those that watch it disappear. These aren't just complex financial theories, they're practical blind spots that can wipe out decades of work if you're not careful. And here's what's crazy. Most high net worth individuals are making at least 3 of these mistakes right now and not even knowing it, especially if they're holding a significant amount of digital assets in their personal name. So whether you're worth $500K or $50 million, these structural flaws are wealth killers. But the good news is every single one of them is completely avoidable if you know what you're doing. Mistake number 1, holding digital assets in your personal name. I don't know how many families I've met with, and this includes family offices, that are holding digital assets in their personal name because their attorneys or their professionals just don't understand this asset class and how it can be involved with the regular way that they structure their estate. So personal ownership, it's going to open you up to maximum liability and exposure. Every asset in your name is discoverable and vulnerable in lawsuits. And I know you're going to say, hey, look, like I lost my keys in a boating accident. I'm going to tell you why that's probably not going to work in the very near future. So high net worth individuals are statistically more likely to face litigation. God forbid something happens. Somebody falls on your property, you rear end somebody. Look, life happens, right? And if somebody else finds out that you have a bunch of money, guess what? They're going to come after you and you need to protect yourself. So digital assets in a personal wallet, they're particularly vulnerable. And I know you're going to say, well, again, like my private keys, nobody has access to this. Look, these are public blockchains, okay? All of these transactions are available out there. All they need to know is what exchange it came from and what wallet it went to. And they can see exactly how much you have. And again, like you said, well, most people are going to say, I don't have access to it, da, 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 da. It's just come out from Ledger that if they were subpoenaed by the government, they would give over your seed phrase and your private keys to whoever they need it to, okay? All of these other wallet manufacturers, it's yet to be seen if they're going to do the same thing. And they talked about an opt-in to upgrade the firmware. And they were met with a ton of backlash because the whole point is the privacy that you get from their product. So again, just another deal for Ledger here. Not so great. But look, you would also want this if there were terrorists, if there were other people that were bad actors or committed fraud, if somebody stole a bunch of crypto from you, you would also want them to be able to recover that, right? So it's kind of a double-edged sword here. The solution for all of this, though, is to get your assets structured in an LLC. A digital asset LLC creates legal separation between your personal and your business assets, okay? So again, somebody sues you, there's going to be a corporate veil that's like a wall between your personal assets and the business if you structured it correctly and you've done all the documentation and everything that we're going to talk about in this video and later on because of some of the other mistakes that people make that allow people to pierce the corporate veil. But if you have that in place, all they can do is put a charging order against you or your LLC. And if you've structured yourself as the first creditor, they're probably not going to get anything. So properly structured LLCs are nearly impossible to pierce, especially if you're working with the right people. So Wyoming actually offers the strongest LLC protections that are crypto friendly with the regulations in that jurisdiction. I get questions all the time. People ask me about Delaware or Florida or Texas, or I got one this morning about Arizona. Look, you could set up an LLC in any of those states. You get strong creditor protection there in Wyoming. And then additionally to that, also no state taxes in Wyoming and They have all of the best crypto regulation already built in there. All the statutes and everything are in place for you to be able to operate in the best and cleanest capacity with the most protections if you do it in Wyoming. So that's why we always set up all of our clients, LLCs, they're in Wyoming if they're domestic here to the US. Sometimes if they're international, I know we're going to get that question here, and we'll cover that later. But you get all of these additional benefits if you're doing it through a Wyoming LLC. And it's minimal cost in comparison to the exposures that you're going to have if you're holding these assets in your personal name. I would even look at it like insurance, right? Like you're paying this, same thing you pay for car insurance, your house insurance. You're mitigating that risk of loss later on. So if it's a couple $1,000s, especially if you have a large amount of digital assets, it's well worth that cost to make sure that your assets are protected. Mistake number 2, most families overpay taxes by not utilizing the available structures. And I don't want to say it's their fault. Most people, again, aren't familiar with the taxes around digital assets, and most CPAs aren't really even going to touch it. They're going to want some standardized tax form like a 1099 DA from your exchange. They're not going to know about TaxBit or, Coinly or some of these other apps that you can connect all of your wallets and your exchange wallets to be able to aggregate the transactions and be able to get the end of year sum, profit or loss on things. And also, each individual one of these transactions, if it's held in your personal name, is taxable. Okay, so if you're a trader, it can become a nightmare for your CPA and your tax and your accountant if you're not doing this the right way. So moving it into a corporation, like we talked about before, allows you a lot of benefits there. Alongside, if you're holding it on a centralized exchange and you're not using a ton of DeFi protocols, you will get a 1099 DA from them. But if you're using, you're getting airdrops and you're yield farming and you're using a bunch of DeFi and you're on Uniswap and you're doing a bunch of crazy stuff, I hope you have a good CPA and you're keeping meticulous track of that. And that's the other benefit of logging all these transactions alongside with written actions and consents inside your LLC. So digital assets have unique tax considerations, again, that most CPAs miss. Very commonly overlooked deductions for crypto investors in particular, hardware wallets and security devices. If you are spending money on that, that is a deduction. That is an expense if you have your assets inside of a corporation. You have trading softwares and data subscriptions that you might have, right? So if you're looking at, publications, I guess it's more on the educational side, where you might also have memberships, travel to events and conferences can be written off. Your home office, if you're trading out of your home, you can deduct, a portion of your insurance and your utilities along with your house payment or the interest on that. There's lots of things that people miss, and they don't really even consider this a business. Many CPAs will tell you it's not a business, you can't do that. I'm telling you can. And there's specific NICS codes for this. Most people, I suggest, using a holding company or management company that specializes in alternative investments with special provisions for their crypto investments, which we'll talk about later on in the video here if you hang out. And all of this stuff is tax deductible. If you purchase a vehicle under Section 179 of the tax code, this could be software or a vehicle. Vehicles need to be over 6,000 pounds. There's some stuff around luxury SUVs this year that don't qualify anymore. But if it's a large vehicle that you're using to travel to locations to meet with other people that you might be investing with or learning from, there you go. That is a business expense. And you are going to have some other vehicle that's your personal vehicle and separate that out. Anyway, you want to work with a CPA that knows what they're doing on this stuff. And you are going to get the benefit if you've moved assets into the LLC and you're managing those through an LLC where you are going to get these write-offs. And again, even working with advisors or other professionals, those things are write-offs, right? The formation of the LLC and any other legal work that you have. I think it's the first $5,000 in the formation of the LLC that you can write off on that side. So it's not going to be included in your taxable income. So the other thing that the benefit of an LLC provides versus like an S Corp, well, I say an S Corp, a C Corp, you're going to get passed through taxation here. You can elect to file the LLC on your taxes under the S Corp election where it's passed through and you're only taxed one time on that. Most people also set up a single member LLC or disregarded entity until, they're going to be generating additional income through this and actually operating a business through it. There's no additional tax implications. And if you do it the right way, there's also tax implications for moving your assets into the LLC, a family limited partnership. And you also have other states where you might qualify for a qualified joint venture between you and your spouse. Many people want their spouse involved with these businesses, which I completely understand. I think there's, California and a couple other states that allow for a qualified joint venture. So make sure if you're going to do that and it's going to be a partnership between you and your spouse, that you do check out that provision and those protections. Most states have really strong spousal rights anyway, so it's not overly complicated. But, if you're not in one of those QJV states, you probably want to set up a single member LLC and then have your spouse as a manager on there so that they have oversight and have the ability to look at what's going on. Timing is critical for this. So a lot of people, they're like, I'll just wait till post price appreciation. Look, three things. One, the creditor protection is paramount. As soon as the assets go up, you're exposed. Somebody finds out, and I know you've told people, I know you've told other people that they should invest in these assets because you're excited about it, right? You want them to get wealthy with you. Look, lawsuits happen between friends and family, okay? I know that's not a fun thing to talk about, but it absolutely happens. And if somebody else gets jealous or greedy, I've seen it happen. So please protect yourself. If you get the assets into the LLC, don't have to worry about that, right? If they sue you personally, they come over to your house and fall on your property or do something silly, right? Which happens. So you've got that. You've also got the anonymity component, right? So, when you're transacting with this stuff post-price appreciation, again, public blockchains, if your information is out there, like you won the lottery and people know that, everybody's going to come knocking. So if you say, well, I just work for this company and they had a big liquidity event and, I got a bonus, people aren't going to know that you own it. You can just be somebody that works there. Okay. You can be the manager, managing member, right? All this stuff is possible. It just has to be spoken about and looked at the right way. In addition to that, along with the anonymity and the creditor protection, you don't want to be rushing around at the last minute. You want to season in accounts beforehand so that you don't get flagged or frozen. Okay. Especially with digital assets, if you're moving large sums off of exchanges, because, if you had it on your cold wallet, you're going to have to move it back to the exchange to sell some, which is going to be a taxable event. All these are considerations, but you're going to be moving that into your personal bank account. If you've never had large sums in your personal bank account and you somehow come into, millions of dollars overnight from an exchange that's crypto, it's going to get flagged. It's going to get frozen. You're going to get debanked. It's going to be weeks or months before you get that money. Please, please, please. And I've seen this happen. So please season stuff in. Have accounts that where you've moved, a decent amount of money through. You've got transactions. It's for a business. You've already had conversations with your bank. Maybe it's, like Chase Private Client or one of these larger private banking accounts. If you can structure that and pay the fee and have things in place, you're going to be much better off and mitigate the risk of your accounts getting frozen or shut down post price appreciation, especially if it is a business account and not in your personal name. You also have a difference here. So a lot of people come to us and they say, hey, I'm just holding these assets for a long time. I plan to use them after they appreciate. I'm just going to, sell for some capital gains, or I want to put them to work in some way to generate cash flow for myself. That's going to be more about what I talked about before. NAICS code 55111-2 or 55111-4. Both of those are going to be from management companies that manage alternative investments that are longer term hold stuff, kind of a buy and hold, which is a lot of people's strategy. But there are other people out there that trade, and you can get a benefit of trading LLC, right? So if you set things up, and there's a specific NAICS code for that as well, the benefit there is you're not taxed on every single transaction. You're just taxed at the end of the year on your total profit or loss, which is great. You don't have to keep up with all the crazy stuff that went on over the year and deal with each individual thing. But the downside to a trading LLC versus the holding company is you're not ever going to get the long-term capital gains benefit. It's always going to be taxable income that's the same year, right? So short-term capital gains are just taxed as regular income. Pick your poison. I've seen people that do both, right? You might have one where you're actively trading strategies and, you're continuing to compound that way if you are an active trader. And then maybe you're buying blue chips or those long-term holds that you're going to put in the other corporation. And all that needs to be documented, especially if there's going to be money passing from your personal name into either one of these LLCs or between the LLCs themselves. You also could be mining and staking. That would also be a different type of LLC versus a trading or holding company. You're going to have different provisions and things in the operating agreement to make sure that everything's structured the right way there. If you're running a validator, staking could be in the trading, I guess, if you had the provisions in there. But if you're actually operating a large, mining pool or something else, it's going to be a separate NAICS code for that versus the other two as well. And then last but not least, A lot of people on the tax side mishandle DeFi transactions. If you haven't looked at Node 40, I would highly recommend those guys. Coinly, I know TaxBit. There's some other softwares out there that are great for going back through a ton of transactions. As long as you know where all of them happened, you can plug them in, and it'll spit out what you actually owe at the end of the year if you are operating in all this crazy stuff that exists in crypto today. Mistake number 3: succession planning of digital assets. I see so many people that come to us, and they know what they're doing. They've figured out exchanges. They've figured out cold wallets. They've figured out, you know, how to buy these assets and hold them and protect them in a way that works for now. And their spouse has no clue. My spouse has no clue. And that's why we've done a lot of what we've done at Digital Wealth Partners and Digital Ascension Group to make sure that we have, like a Schwab account for your digital assets. But not everybody has enough to be able to do that. So if you don't, and you do set up the LLC, if you got somewhere between $50,000 and $80,000 worth of digital assets, that's about the time that we think this makes sense. That's an appreciable amount that you want to make sure that you have a lot of this stuff in place for, right? You want ways to prevent the loss of your private keys. You're going to want, a way to recover this stuff if something bad happens. Probate courts can't access your digital wallets. And so, you want some type of procedure written out in this LLC or the way that this is structured to mitigate the risk of loss. I mean, how many people have you heard about that, something happened to them and they had all this money in digital assets and then their family couldn't get to it, right? I think Matthew Mellon, who was like part of the BNY Mellon family, passed away tragically, and he had a ton of like XRP, which I think they've recovered at this point, but it took them a long time to figure that out, right? So stuff like that. I'm sure that there's people with, we met a family that had a bunch of Bitcoin on a hard drive that they didn't even know about, that they found after their father passed away because it wasn't listed anywhere. All of this stuff can be mitigated if you've done this the right way and you've set up the LLC and you have all these provisions in your operating agreement. So there's no documentation around the wallets that have been lost for their locations. That's a big problem a lot of the time. If you haven't updated your will, at a minimum, at least put this stuff in your will and have a crypto buddy that can help your family if your wife or spouse is not proficient with digital assets, right? So you want it documented somewhere. You want the private keys known so that it's not just you that knows them. When I, didn't have institutional custody, I had a lot of wallets and I had all the seed phrases in multiple locations in case a house burned down or something else bad happened. Some are like buried in the backyard. Some are in a lockbox somewhere. Some are on the premises. But that's denoted somewhere so that somebody can find them, right? Especially your spouse, hopefully, or whoever you want to get them, your beneficiaries on the other side of, again, nobody likes to talk about death. I don't either, but these are all considerations. And if you want to do the best thing for your family, you want to make sure that you have a succession plan in place. So you might also have multiple family members that have different pieces of the keys that have to come back together. I met with the family office just the other day. They've got a financial committee and, they got 4 people on the financial committee, and each one of those individuals has a portion of the keys that they bring back together on their quarterly meetings to be able to rebalance their portfolio of digital assets. Very crude. And God forbid something happens to one of those people. I'm sure that they have additional recovery mechanisms at this point. They were a very sharp group. But you just want to make sure that stuff's segregated. Maybe you even have multi-sig on the wallets, right? If you have some type of governance where multiple people have to sign, if it's over a certain amount, it's going to be difficult to do with just a cold wallet. You're going to need institutional custody for that. You're probably also going to want, emergency access protocols if something were to happen. All of this should be written out in your operating agreement for your LLC. And for everybody, it's going to be a little bit different. We provide a template that has a lot of this stuff structured in there. You can work with your attorney to change a lot of this stuff, or you can have an attorney draft all of it for you. But you want to make sure that you're working with an attorney that knows what they're doing when it comes to digital assets and includes all these provisions in your operating agreement so that there's not any potential losses or gaps in what you're doing. So you're also going to want regular reviews and updates of access to these procedures, and consider, like I said before, institutional custody. If you do have, over at least $500,000 in your portfolio currently, you can absolutely reach out to Digital Wealth Partners and they would love to work with you. If you got over 100,000 XRP or $500,000 in your total portfolio, and that includes your traditional assets and your crypto assets, Digital Wealth Partners can help you handle all of it. and make sure that a lot of this just kind of goes out the window with cold wallets because it's, you have beneficiaries and a spouse on the account. You don't have to worry about all these additional provisions here because it's inside of institutional custody when you're working with them. So mistake number 4 is going to be commingling your business and personal assets. There was one guy that I helped when I was doing M&A that he had paid for his daughter's quinceañera out of the business. That's a big no-no, okay? You can't do that. You need to pay yourself out of the business. All these things need to be documented. And also for digital assets, this is a consideration that a lot of people don't think about. Written action and written consent are actually, I don't want to say required, but they really kind of are because people haven't caught up with on-chain data yet. The government still thinks that you need separate records for everything, even though those separate records could be manipulated. And the on-chain data is what's actually happened. You do have to keep separate records. And that's also, why you want to make sure that you have written consents and written actions for assets in and out of the business. And that separates the commingling of funds. Okay. If you don't do this, it creates accounting nightmares. People can pierce the corporate veil if you're in a lawsuit. The IRS has additional scrutiny when it comes to commingled assets between business and personal. So you want to work with a paralegal group. We work with Laughlin Associates. They're fantastic. So you may have other businesses outside of digital assets and you're thinking, oh no, I've done some of this stuff. I would highly recommend working with them and they can get things structured for you and make sure that stuff's done the right way so that you have a corporate veil that is not pierceable on a lawsuit and everything's super clean when you go to do your taxes. So again, a lot of the common mistakes that we're going to see with this is using a business wallet for personal transactions in digital assets. Big no-no. Don't do that. We need separate wallets for, your business and your personal. Same thing with exchanges. If you have personal accounts on exchanges, great. You need a business account on the exchange as well. Paying for the expenses for the LLC out of your personal account. Again, need to transfer it into the business account or have a written action or have your accountant, settle that difference to make sure that your books are clean. Transferring between the entities. So like I talked about before, if you have a trading LLC and a holding company and you buy some assets with the trading LLC that you want to transfer into the long-term hold so that you get the benefit of long-term capital gains, you want to make sure all that's documented, right? There's going to be a written action and an exchange of value between those two entities, and it needs to be documented. Other people also have unclear ownership of their assets. Well, is it in the LLC? Is it in my personal wallet? What's the best thing in this circumstance? You can't have a fly-by the seat of your pants attitude for this stuff. Okay. You need to be working with professionals and it needs to be done the right way. Otherwise, you're opening yourself up to risk. And, I've seen people that go to LegalZoom and, we'll talk about this in mistake 5, but they don't know what they're doing. This sounds good, right? And they're like, I don't want to spend the money to work with professionals and pay that extra amount. I'm going to cheap out a little bit. I'm going to try to do it myself. And you can. If you really know what you're doing, if you've done a lot of research online, you can absolutely do all this stuff yourself. Wouldn't recommend it. You want an attorney that's going to represent you in court and maintain that corporate veil for you and present all those records on your behalf. But, if you are a go-getter and you can do it yourself, then make sure it's done right. But I would not recommend LegalZoom. Any cookie cutter templates offline, not so good. So the proper way to do this is to have dedicated wallets between each entity, clear documentation between all the transfers, written action, written consents, separate exchange accounts like I talked about, for your LLC versus your personal name, different hardware wallets to prevent confusion. We have a lot of people that want to gift assets to their children. You want to set up separate hardware wallets for them also would be ideal. And then you would gift, up to $19,000 per person per year. And you can move it onto that wallet. It's just one transaction. That way it's super clean and easy. And it also needs to be documented somewhere as the gift, hopefully with your accountant. And you're going to have these detailed logs, like I mentioned. So business purposes, if you are in a lawsuit, they're going to say, okay, all of these transactions were all of these for business purpose. And you're going to have to prove that. There's going to be receipts. There's a bunch of other stuff. And again, you want this structured and detailed the right way. You want to work with a paralegal firm and review this stuff on a regular basis. And reviewing it, if we work with Laughlin, you're going to review it at least 10 times a year. They're going to get all the information from you and they're going to make sure that all this stuff is written out and done the right way. It's some extra time. I know that it is, but again, the benefit far outweighs the potential losses here if you're doing this the right way. All right. So you hung around for it. Mistake number 5. And that's using generic structures for your digital assets. So like I talked about in mistake 4 there, a lot of people will just go out to LegalZoom and they file an LLC in Wyoming and they think they're done. You need a registered agent. in Wyoming, potentially even a virtual office there in Wyoming. You want the right operating agreement. Traditional operating agreements that you're just going to find online somewhere if you just give it a Google are not going to have the provisions and all the benefits that you're going to be required to operate with digital assets, and you're not going to get it set up the right way. Even most CPAs, if you go to a CPA and you say, "Hey, I want to set up an LLC for my digital assets," they're going to set you up a trading LLC. They don't even know about this concept for managing your digital assets through a holding company. I know some prominent ones that just have a hard time understanding that. So generic structures are going to fail to address private key management, how you're going to handle forks or airdrops, the governance around who signs the wallet and for what amount, and all the provisions in there to make sure that things are done the right way when you're making transactions, how you're going to work with staking and yield farming operations if you're going to do that. Again, DeFi protocols and your interactions there, and then also cross-chain asset management. So let's say, you want to mint and issue an asset on another chain, like Flare, as an example. This isn't out yet, but it's something that we're looking at for a lot of the operating agreements that we provide our clients because they tend to work with XRP. They also have Doge and Bitcoin and many other things that you're going to be able to mint F assets for there on Flare. How are you going to work with that? What are the considerations inside your corporation and management for those assets, and how's that going to work? All that needs to be denoted. If you're not doing that, again, and you start doing these things, you're opening yourself up to problems. So digital assets require specialized provisions. You need something around custody and your security protocols. These need to be technology specific, and they need to be about risk management of the assets. You're also going to want something in there about, regulatory compliance and the procedures that you're going to follow as things kind of roll out here with the Clarity Act. And also we got the Genius Act that already passed. We put out an updated version of our operating agreement in the recent past to help people on that front. Also, in addition to that, you would have emergency access mechanisms or wallet recovery procedures, right? Like we talked about, if they are stored on a cold wallet, you probably want those provisions in the operating agreement. If you're in institutional custody, you're good to go. You don't have to worry about all that stuff, right? Because you have an account at Anchorage with Digital Wealth Partners and things are done the right way. You know that, everybody's going to get the assets. You probably also have the built-in governance there on who signs what for how much, if your trustee's involved, if it's inside of a trust, which we're not talking about in this video, but we do provide our clients, if they want an asset protection trust to manage these assets, that's even more, creditor protection. And you also get, probate protection through that as well. You're not going to get probate protection through the LLC. So I want to give people that kind of note here. A way that we've structured this with our clients as things have progressed, if they are concerned about probate, is we'll set up a living trust in their state that sits on the cap table or owns the LLC. And that way you also have the creditor protection that you get from the LLC. And now you have probate protection through the living trust. It's just a simple living trust. It doesn't provide any creditor protection at that level, but the combination of both work well until you have enough assets to warrant an asset protection trust there in Wyoming. You're also going to have, speaking of Wyoming, state considerations for the digital assets. Many people will set up LLCs in other states that don't have statutes for digital assets. Again, I have so many people come to me and ask, Florida or Texas or Illinois or New York or California. All of those are great for other reasons. Okay. California and New York you have a lot of taxes. Maybe you want to pay a lot of taxes, but if you want the best thing for your digital assets today, how it sits right now is Wyoming and what they have there. And that's why we structure all of our client stuff there. You also might think about international tax implications, right? So if you are overseas and you want to have something here in the US, a nexus, I don't know that you want to establish that. You need to really think long and hard before you do that. Many of our clients just want to jump into something because they're excited about it. You'd like to talk to a tax professional in your jurisdiction, wherever that might be, to make sure that you have, a double tax treaty with the US. In that, you're going to pay taxes wherever they're higher between the two, right? So all these things are considerations when you're establishing this stuff when you're an international client. And then last but not least, again, just want to hit this home on the generic structures. People, again, oftentimes do not have a separate record for all their transactions in the LLC. You would think, again, on-chain data is exactly what happened. You'd be able to present that and it would be no issue, but you do need to have an additional ledger that shows all that information. I think over time, as governments catch up and understand this technology, they'll understand that the on-chain data is exactly what happened and that the other stuff can be manipulated. But today, here in 2025, They still want separate records. So, and if you stuck around, here's some additional considerations that you might have if you're setting this up properly and other mistakes that I've seen people make. So, banking relationships. I don't know about you, but if you have ever walked into a bank and you said, "Hey, I want to set up an account for my crypto," they've told you to get lost. They will not set up high risk accounts. So that could be for gambling. It could be for cannabis. There's a bunch of industries that most banks will just, nope, no, thank you. Too risky for us. So when you go into the banks and talk about this stuff, again, this is another benefit of working with us and setting up the LLC the way that we do. You're going to provide them that NAICS code. They're going to say, "Hey, what line of business you're in?" You say, "Hey, my NAICS code is 551112 or 551114." They're going to pull that up and it's going to show a management company or a holding company that manages assets. Cool. That works, right? If you have a crypto trading company and that's how you set this up, probably not. So just be aware of those things, and you're going to need a crypto friendly institution. Old Glory seems to be pretty friendly. Mercury also been pretty friendly when it comes to digital assets. And you're going to need the proper documentation to set this up. You're going to want your operating agreement, certificate of good standing. They may ask you for some additional information as well when you're setting these things up. The EIN letter, you're going to have all that, right? And you want it in a nice folder or maybe in a Google Drive or somewhere that's easily shareable with the institution. You're going to also want, the regulatory compliance piece in here. FinCEN, and they had, the BLIR that they rolled out and then retracted. I don't know if that's going to come back or not. That's a consideration. You also have state-specific crypto regulations when it comes to these digital assets. Again, like I talked about, we always do Wyoming because it's the most favorable and you have the most regulation there and statutes that protect you. If you do it in another state or another jurisdiction, you want to understand all of the reporting obligations that you're going to have there and all the other considerations around that. Some of the best practices that I've seen when it comes to cold wallets and long-term holdings is, again, that multi-sig. If you can set up something where you're using a wallet that does have a multi-sig on it and you have a counterparty that also has to sign over a certain threshold, that's great. Whitelisting also, if you are holding your assets somewhere and you're concerned about it getting hacked for whatever reason, if they have a whitelisting option, you could list your cold wallet as the only place that it can be sent to from there. We have that at Anchorage. So again, we don't believe that anything's going to happen there because of the security and how robust that is. But if anything ever did, worst case scenario, they're just going to send it right back to your cold wallet because it's the only place they can send it to. The other thing that I've seen again with that other family office is they have people that live on different continents that have access to the keys, right? Or a portion of the keys that have to come back together in order to be able to make a transaction or rebalance their portfolio. And then last but not least, you're going to want regular security audits, right? On any of this stuff that you're doing, whether it's the cold wallet, hot wallet exchanges, institutional custody, you want additional security audits and improvements on the security over time. I know that Anchorage is working on some quantum resistant stuff right now, which will be disclosed later, which will be awesome. But they're always looking to improve the robustness of their security protocols and auditing them on a regular basis to make sure that there aren't any breaches. And then last but not least, please, 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 please find professionals now. Okay. And it doesn't have to be us. I know, I have a bias. I think that we have the best professionals in the world when it comes to digital assets, and that's why we do what we do. But, if you can find somebody in your backyard that you trust, that's a good CPA, a good estate planner, tax attorney, wealth manager, that's willing to work with you on this stuff and understands it in a very deep manner and is, in the top of their field, find them now. Because on the other side of price appreciation, there's going to be a lot of sharks. Okay. There's going to be people that are out to get you. You're not going to know their best intent or that if they have the best intent in working with you or if they're there just for the money, right? You want people that actually care about you, want to do business with you, and don't treat you like a number in their business. So if you can find attorneys that are familiar with digital assets, other advisors, if you're international, that understand, if you're going to be operating in multiple jurisdictions, both tax laws in either one of those jurisdictions. We have a great relationship with Aaron Grinhoss up in Canada. He works with our Canadian clients to make sure they understand the tax implications if they're going to set stuff up here in the US and they're a Canadian citizen, if they're going to continue to live there, how that's going to be taxed. If you're going to move here to the US, you're going to get some additional benefits. So you might want to set it up offshore because you're worried about your government or the tax structures there. There's just a lot of things going on in this space and not a whole lot of professionals that really understand this stuff. So we've had the blessing and I'm super grateful to have been connected with so many fantastic people that really do know what they're doing all over the world. We work with people in the EU, in the UK, in Japan, in Australia, in South America, and in Canada that all have very strong proficiencies with digital assets and are the leader in their field for whatever respective vertical they operate in, whether that's CPAs, accountants, tax attorneys, or the estate planning. I really haven't found any other wealth managers that do what we do. I think we're the only people in the world that do it, which is wild. So if you do want to work with digital wealth partners to help manage your digital assets, provide you line of credit, set up an FBO account with segregated, bankruptcy remote, and insured up to $100 million, we're it, man. So just go to digitalwealthpartners.net on the wealth management. But for all of these other things, I think you should be able to find somebody in your jurisdiction if you do the research. So in closing, implementing these strategies isn't something you do overnight, okay? You just want to start with the basics. If you're holding a significant amount of digital assets in your personal name right now, your first priority is to get them protected, okay? So here's what I recommend. Today, make a list of all digital assets and where they're currently held. Second, research the LLC formation in Wyoming. You don't have to do it through us. You can work with another attorney, but please, please, please start structuring this today so that you get the benefits of the statutes that are specifically designed for digital assets in that location, and you get the creditor protection, the anonymity, and all the other stuff I talked about. And then last, I would try to find a CPA so that they're going to understand these tax implications when it comes to digital assets. They can help you draft those provisions in the operating agreement when it comes time for that, maybe with your other attorney that may or may not have the expertise in crypto, but most of them don't have this, right? So again, we have a Rolodex of CPAs that we can provide you if you want to email info@digitalfamilyoffice.io. We, again, happy to provide those people. I want people to have resources. And again, I don't care if you guys work with us. At the end of the day, we found all these partners through our relationships and network, and I'll vouch for them. They've done fantastic work for our clients, and we're happy to share them with you. So the biggest thing is you don't want to wait until something happens. Like I talked about before, too many families scramble. They're emotional. Something big has happened. They're excited, and now they want to protect things and set things up, or they've already sold some, and then it's too late. The best time to set things up to protect stuff was yesterday. The second best time to set things up is right now. And for those who want to go deeper, we actually run a mastermind group. It's called the Beyond Broke Mastermind Group. We have over 6,500 members that are in that group. And we talk about implementing all of these exact strategies. We share what works, what doesn't work, all the professionals that we have in our network. And if that interests you, you can definitely check that out in the links below. So let me know, comment below. Tell me, have you made any of these mistakes? Are you committing any of these right now? And hopefully, you're able to rectify it with the information in this video. So until next time, stay curious, stay ahead of the curve. We'll see you guys on the next one.